Hello, everyone. Welcome back to the Final Bar. This is Dave Keller at StockCharts.com. I want to welcome on my guest, Ari Wald from Oppenheimer, calling in from New York. Ari, thanks so much for joining the show. We really appreciate it.
Of course. Thank you, Dave, and congrats on the new show. It's really great.
I appreciate it, and I have to tell everyone. So I've known you for a number of years, and during my Fidelity days, I would say, and nothing against your peers in the industry, but there are a small subset of sell-side analysts coming through that sort of a must attend, that you'd want to pay attention to what you said, and you were certainly on that short list. So I'm really excited to hear what you're telling clients recently. And the first chart is the European stocks banks index. What are you seeing here?
That's right. Well, the lead-in is that we have the S&P 500 still stuck in a range, but we think the pieces are slowly coming together to what should be a breakout in the S&P, a more bullish 2020. And I think the key positive that I wanted to discuss today is that participation is slowly starting to broaden out globally, specifically in Europe, emerging markets, and the U.S. too. So let's start with that chart of the European banks, which has really been a critical risk-on area of the market in recent years. And we want to highlight that the industry is basing at decade-long support dating back to its 2009 low. Now, we're flagging that the current turn looks similar to the turns in 2012 and 2016, and specifically that each of these bases developed in three stages. First, there was an initial high-intensity low, which is the bang. That's usually followed by a less intense low, which is the whimper. And each one was finalized with a snapback rally above the 200-day average. So we're making the case that December 2018 was the initial high-intensity low in Europe and for Europe banks. This was followed by a less intense low more recently in August. And now this month's rally above the 200-day average is confirming the reversal. And the assumption here is, very easy. We expect this to develop again as long as that 200-day is upheld. That's our stop level.
It's really interesting. And again, the parallels to what we're seeing now versus what we've seen in 2016, 2012, really clear on the chart. You can see the reaction off of support. So interesting bullish case. I like that. Now, the second chart you had was on emerging markets. What are you seeing here?
That's right. Not just Europe. We also have the iShares Emerging Markets ETF, ticker EEM, which has really been in the crosshairs of the U.S.-China trade war, also stabilizing at major support. So the first thing to note for EM is that the advance back in 2017 reversed a 10-year downtrend dating back to 2007. EM went on to peak in early 2018. It had a really textbook bear market that bottomed a year later, and now has spent the entirety of 2019 building a base. So it still needs to complete the base with a higher high above the April peak at $45. But we see this potential and the opportunity for rotation, which would be another tailwind for the global bull market scenario.
That's really interesting. Now, your third chart I want to get to because it's leaning more a little into the U.S. But before we do that, it strikes me that the two things you've shown with European banks starting to look more attractive, or a compelling, long idea here, emerging markets starting to roll up and threatening to break above that swing high. I would assume many clients you're talking to would be sort of caught off guard with this sort of thing because we're kind of comfortable with the U.S. over the world and just forget about international markets. Is this a catalyst, or is this a signal that we should be paying more attention to non-U.S. versus U.S. at this point?
I think it's less of a relative call. I think what was just a narrowly led advance by the U.S. is now broadening out. I don't think the U.S. should be disregarded here, and that was the lead into the third chart. I think it's more so that you're filing on all cylinders. U.S., Europe, EM really makes for the bull case overall.
That's fantastic. Now, the third chart you sent deals specifically with breadth in the form of the value line index. What do you see here? Yeah,
so and to kind of hit on that point that within the U.S., that in fact, I think this is where U.S. breadth broadens as well. Here we're charting the value line geometric, which is an equally weighted composite of about 1,700 issues. It's more or less a gauge of what the median stock is doing. And the important signal to flag is that this breadth index is testing its major breakout above its 1998 peak. That was a secular breakout. So here again, more is needed. If we think in terms of the Russell 2000, which looks similar to the value line on a daily basis, we know we haven't had the breakout move in small caps yet. Mm-hmm. The level of breadth really can't be disputed, and it's currently unconfirmed, but it's the direction where we might see differently than others. You know, while one with a bearish view would point to a lower level versus the peak reading from last September in terms of the Russell 2000, we're keying on the higher level versus the low reading from December, meaning we think directionally participation is positioned to broaden rather than contract. And the fact that it's carrying at such an important support level makes it all the more compelling.
That's great. We've talked about breadth a number of times on the show. We've never, I don't think that I remember, brought up the value line geometric as a way to illustrate it. That's really, really well done. Ari, 3 fantastic charts. I really appreciate you coming on and sharing those with us.
I appreciate you having me on, Dave. I always like to remind you that your signature is on my CMT certificate when you were the president back in 2011 when I got it. So thank you for that, for signing off on that. Yeah.
And very, very well deserved. Ari, good to talk to you. Thanks again for coming on, my friend.